All right, welcome everyone. Today, we are going to dive deep into a concept that's frankly at the absolute heart of financial literacy and smart business leadership. It's a puzzle that has tripped up even the most seasoned entrepreneurs, and it's something every single one of you really needs to master. We're talking about the profit paradox. We're going to explore that critical and often very misunderstood relationship between a company's reported profit and its actual cash in the bank.
So let's just kick things off with a big question. I want you to really think about this for a second. Imagine you're looking at a company's annual report, and it's showing millions and millions of dollars in net income. By all appearances, it's a huge success story. But could that exact same company be just a few weeks away from having to shut its doors for good? The short answer is a resounding 100% yes. And our goal in this explainer is to understand exactly how that's not just possible, but actually dangerously common.
And this slide right here just perfectly illustrates the paradox. I mean, look at this. On the left side, the income statement is telling a fantastic story, $1 million in profit. That suggests success, growth, smart management, right? But then you look over to the right, and the bank statement tells a story of absolute crisis, a negative cash balance. That means the company can't pay its bills, it can't make payroll, it literally can't survive. So how can both of these things be true at the exact same time? Well, it's because they represent two different but equally vital views of the business.
Okay, so to solve this puzzle, we first have to really understand the fundamental difference between profit and cash. Profit, or net income, is an accounting concept. Think of it as a measure of performance over a period of time, like a quarter or a year. And crucially, it's calculated using something called accrual accounting. The core idea here is the matching principle. We're trying to match our revenues with the expenses we incurred to generate them, and this is the key part, regardless of when the cash actually changes hands. Cash, on the other hand, well, cash isn't an opinion or a concept. It is the physical, tangible lifeblood of the company. It's the fuel and the engine that you need for day-to-day survival. This famous saying in business, it just captures the idea perfectly, and for good reason. So why is profit an opinion? Well, think about it. Calculating profit requires accountants to make all sorts of estimates and assumptions. For instance, how long is this new piece of machinery going to last? That's an estimate, and it directly affects your profit. What percentage of our customers who bought on credit will never actually pay us? That's a judgment call. Those decisions directly impact that final profit number. But cash? Cash is a fact. It's binary. You either have the money in your bank account to make payroll on Friday, or you don't. There's no estimate involved there. So, if we have these two completely different worlds, the accounting world of profit and the real, hard world of cash, how do we connect them? How do we get the complete picture? Simple. We build a bridge. And in accounting, that bridge is the statement of cash flows. Specifically, we're looking at the very first section, cash flow from operations. This statement is a formal reconciliation that allows us, as managers and as analysts, to translate that performance story of net income into the survival story of actual cash.
And this slide here brilliantly illustrates the path we're going to take. The reconciliation process is a logical, step-by-step roadmap. We always begin with net income. That's the number from the bottom of the income statement. Then we add back expenses that were recorded on the income statement but, and this is key, didn't actually involve an outlay of cash in this period. After that, we adjust for changes in working capital, things like accounts receivable and inventory. And finally, we arrive at our destination, net cash from operations. Now for today, let's really dig into step 2, because honestly, it's often the most confusing part for a lot of people.
The term itself just feels like a contradiction, doesn't it? An expense that doesn't involve cash? It almost sounds like some kind of accounting trick. But it's a fundamental and totally necessary concept in accrual accounting, and you have to get it to understand how a profitable company can be cash poor. So let's unpack this.
We're going to use the most common example of a non-cash expense to really understand this, depreciation. I like to call it the phantom expense because it shows up on the income statement, it reduces our profit, but it never involves a cash payment. You never ever write a check to depreciation. And while it's the most famous one, remember, there are others, like amortization. But understanding this one phantom is the key to solving the entire paradox.
So let's break down the formal definition. The key phrase here is allocating the cost. So why do we do this? Well, imagine your company buys a big machine for $100,000. It would be completely misleading to report a massive $100,000 expense on day one, right? It would make the company look hugely unprofitable when that machine is actually going to help you generate revenue for the next 10 years. So that matching principle demands that we spread or allocate that cost over the machine's useful life, which is our best estimate of how long it'll be productive. So really, depreciation is just the slice of that asset's cost that we use up in each accounting period.
Okay, theory is one thing, but let's make this tangible. I want you to imagine you are the entrepreneur. You've just launched a brand new delivery service. You've got customers lined up, drivers are ready to go, but to actually make those deliveries, you need your most important asset, a delivery van. And this is where our story of profit versus cash really begins.
Okay, let's walk through this carefully step by step. You buy the van for $25,000 in cash. Now that initial payment is a huge cash outflow, but it gets classified as an investing activity on the statement of cash flows, not an operating activity. And that's a super crucial distinction. Right now, we are focused only on cash from operations. So let's look at year 1 of using that van. You estimate it'll be useful for about 5 years. So using simple straight-line depreciation, you'll allocate 1/5 of its cost, or $5,000, as an expense for this year. So look at the top row of our table. On your income statement, you record that $5,000 depreciation expense. This reduces your revenue, and therefore it lowers your net income. Makes sense. Now look at the bottom row. This is the bridge back to reality. To find our true cash from operations, we start with that lower net income figure. But then we have to ask the critical question. Did we actually write a check for $5,000 to anyone for depreciation? No, of course not. The cash for the van left the building long ago as an investing activity. No cash left our wallet for this specific operating expense in year 1. Therefore, to get back to the cash reality, we have to add back that $5,000 phantom expense.
This all builds to a really simple core principle. This sentence on this slide is what I want you to remember. Recording depreciation is absolutely crucial for accurately matching expenses to revenues over time. That gives a truer picture of your long-term profitability, and it's essential for calculating taxes. But when we're analyzing the cash position for the current period, we have to recognize it's just a paper entry. It's an expense on paper, on the income statement, but it is not an outflow from your company's wallet.
So we've untangled the accounting. But why does this actually matter to you, as a future manager, a future CEO, or an investor? Because understanding this difference isn't just some academic exercise. It is fundamental to making sound business decisions and, frankly, to ensuring a company's survival. Your ability to read both of these stories, the story of profit and the story of cash, it directly impacts the health of any organization you will ever lead.
And I really cannot overstate this. If you manage your business or even your department by looking only at the profit and loss statement, you are basically flying an airplane while staring at the speedometer but completely ignoring the fuel gauge. You might feel like you're going incredibly fast, but you could be just moments away from the engines completely cutting out. This one mistake is one of the most common reasons why seemingly successful businesses fail.
So let's look at some real-world blunders this causes all the time. Imagine this. The income statement shows record profits. The CEO proudly stands up and announces, "Great job, everyone gets a huge bonus." But the finance team is in a full-blown panic because they know the company made all those sales on credit. The cash hasn't actually come in yet, and there isn't enough in the bank to cover those bonus checks and next month's payroll. Or think about a marketing manager who pitches this brilliant, expensive new campaign based on high profits without ever realizing the company simply doesn't have the cash on hand to pay the ad agencies. These aren't just rookie mistakes. They happen in huge corporations when managers lose sight of cash.
And if you need any more convincing, here is the data. A study by U.S. Bank found that a staggering 82% of small business failures are due to poor cash flow management. It wasn't a bad product, it wasn't poor marketing, it was simply running out of money. It just proves that a company can be profitable on paper right up until the day it has to close its doors because it can't pay its bills.
This bit of wisdom from one of the world's most successful entrepreneurs, it just sums it all up, doesn't it? Think of it this way. The income statement is the heart. It measures performance. The balance sheet is the skeleton. It shows the company's structure. But the cash flow statement, that traces the lifeblood. Without positive cash flow, the business dies, regardless of how strong the other parts might seem.
So we'll end with this thought. We've demystified depreciation as one key phantom figure today. But as you continue your studies, I want you to always think critically. What other items on the financial statements are based on these accrual accounting rules rather than on immediate cash movements? Think about how we record sales made on credit, which creates accounts receivable. That's profit on paper, but it's not cash in the bank yet. Or think about how we account for inventory. Understanding these nuances is really what separates a good manager from a great one. Thanks for joining me for this explainer.